Hey guys, hope trading is going well for you. It's me again, Forex James, and in this video, I want to talk to you about how to set your take profits target the right way. Exit is probably one of those final puzzle to your trading game. And in this example, I'm not talking about an exit with a loss, okay, which is when your stop loss gets hit, but rather on an exit which you will win. Because setting a stop loss is pretty straightforward to me. I'd place it at a point where, according to market structure, if it gets hit, then the reason for me going to the entry is no longer valid, right? It's as simple as that. I think it's gonna go up. If it surpasses a certain point below my price point, then I know I'm probably wrong and that it's gonna go down. Yeah, that's how I would set my stop losses according to market structure. But on the other hand, when we're talking about setting our take profit targets, there are so many factors to look at. These are some of the questions most traders have in mind. Should we be setting a fixed take profit target, be it a 1-to-1 or 2-to-1 or 3-to-1? What if it turns out that after we got out at our fixed profit targets, the trade even went further? How would you feel about leaving so much profit on the table and not being able to maximize on your trade? What if this time you decide that, okay, that was what happened last time, and this time I'm going to run my profits? So you decide to do that, but instead, this time, the market is not ready to take off. So you could have gotten your 2-to-1 or 1-to-1 or 3-to-1 risk to reward trade, but instead, since you decide to hang on to it, not take your profits off the table, it turns out that your trade becomes a break-even trade, okay, if not a losing one. And basically the question is, how do I get the most out of my trades, right? And so in this video, guys, I wanted to share with you some tips on how you could make better exit targets. Okay, first of all, the most important tip is that your exit must be set accordingly and strategically based on the market structure, not based on what you feel or what you want the market to do. It's actually common sense, but a lot of traders are not doing it the right way. And of course, there's lots of emotions that go on after you have a position or when you're about to place your trades. Okay, so it's important to go back to what you see on the market structure, not so much of what you want or what you feel or what you think. Okay, set your TPs on what you see. So I've labeled these exit points into three kinds of areas of the market structure where you can set your TPs at. The first point, the most conservative TP target, is that when you assume that the opposing force will win. What do I mean by that? Let me show you. Say you're in an uptrend, okay, and you decide that you want to enter on a pullback, okay? Or if you are pretty much a pullback trader, your ideal entries would be when it dips, okay, right over here, these dips, okay? Number one would be somewhere around here, okay? Why? Because if this fails to make a new high, if the bears jump in and it decides to change its course or fall into a range, then the safest point to take your TP at is at point number one, okay, which is right before the previous high. In a lot of my trades, I'd be happy if I could get out at point number one. So as long as you're able to get into a buy trade here, okay, and be able to achieve at least a 1-to-1 when you exit here, okay, no matter where you enter or how you enter, let's say you decide to wait for more confirmation, okay, and that means you lose out in part of the movement. But as long as you can get a 1-to-1 or a 2-to-1 at point number one, I think that's pretty decent, okay? Because after all, if you're able to consistently make those winning trades consistently, okay, you'd see your equity curve grow. The second point of TP would be to anticipate if a range would form. So back to that similar example, except let's use a downtrend this time. Okay, you decide to go short after a trend and you get short over here. Okay, point number two would be an equal low. Why? Because a trend cannot be trending forever. Remember that a range would eventually form before the trend would continue or reverses. Okay, so point number two is actually an equal low of the swing, or an equal high should it be an uptrend. So we have point number one, which is somewhere around here before that equal low, and point number two would be an equal low, more or less, okay, give or take a few pips. This is to anticipate should a range decides to form. And of course, last of all, the most aggressive TP target would be point number three, which is a new high or a new low. This is point number one. Point number two, this is point number three. This is the most aggressive TP target because we don't know if price is going to still continue to make new highs. We could only assume that the previous high would be broken. If you're a pullback trader, the best scenario that could happen to you is, of course, if a new high is made. That would mean that you'd make the most profits out of those three TP areas. But in order for this to happen, remember that old highs have to be broken. And a lot of times, price don't just trend like that. Okay? You see it range first. It may hit your TP1 right over here. Then it would go back to TP2 before eventually making that new high and reaching your TP3. So the three areas of TP points which I've just shared to you are the areas of where you should take your take profits at. You can't be like, oh, I'm going to enter over here and I want to hit a 5-to-1. Okay, that's not very realistic, guys. You have to be able to see where you are in the structure, okay, and where is your stop loss. Your stop loss also has to be placed correctly. It cannot be minimized just for the sake of increasing your reward to risk ratio. I'm not going to go through that in this video, okay? It's going to be too long. With that information, I think a better approach is that to measure the most likely target that's going to hit, okay, regardless of your entry type, pullback, breakout, counter trend, or range. And in that case, it's going to be point number one. Okay, point number one is the most likely target that's going to get hit. Not point number two, not point number three. Okay, with that information, you should ask yourself, from your point of entry, okay, with your stop loss fixed, How far is point number 1? Okay, if you're able to make at least a 1-to-1, I would consider it to be healthy. Okay, anything more than 1-to-1 would be awesome. So again, the first thing you do is you project where the market's likely going to go and how likely is it going to hit it. Okay, once you do that and you've defined where your stop loss is going to be, you then decide if this entry is worth it or not. Okay, that's how you should approach and assess every trade. If you're doing it right, you'd be able to yield trades with positive expectancy. I've put up a chart of gold here on the daily time frame. Okay, for example's sake, let's take a look at this down move here. Okay, you see it making a pullback, right? After that pullback, it made a turn to the downside. This huge bearish candle kind of defined and marked the turning point in price. Okay, as you can see, point number 1 will be somewhere around here. Right there. Which it pretty much hit within one candle. And then point number 2 would be an equal low. Okay, which it tested many times before eventually it could hit point number 3, which is an extension of this move, basically. Okay, one last tip for you guys. If you're trying to measure where is your point number 3, remember the ABCD pattern. Okay, just pull a trend line across from these 2 swing points and extend it to where it made the most pullback. Okay, it's not going to be accurate, but you get an idea of where price is likely going to go, and in which in this case it never went that far. Another example here, also a downtrend. If you had entered a short here, your point number 1 would be somewhere around here, assuming that the bulls would jump back in, which it did, okay, before it hits point number 2. But in this case, at the same time, it made that new low. Okay, measure this again. This is the projected low, okay, in which case it surpassed a little bit. So I wanted to end this video, guys, with one little note, which is that before you can aim for those big profits, you need to be consistent first. And what do I mean by consistency in trading? Is when you see your equity curve sloping up very nicely, okay? You want to see your gains, your smooth gains. At the same time, you don't want to see those big drawdowns. It doesn't mean anything when you win big, only to lose big the next day. What you want is to achieve those consistent, steady wins over time. And you'd be able to use the tip I gave you, okay, which is to measure your risk to reward to point number 1 and just focus on making good trades. Okay, and what do I mean by a good trade? Anything that could yield you more than a 1-to-1. So if you keep doing that, I promise you guys that you'd be able to see improvement in your results. Okay, and do keep a journal, guys. It's one of the best things I've ever done to myself. Okay, thanks for watching. Good luck in trading as always. Leave me a thumbs up if you enjoyed the video. Bye now. Yeah.